Hello guys, welcome to the Capitalist video channel, right? So thank you for listening in. So today we're going to be talking about one very interesting thing where most people, when they first started trading, will definitely be asking. What the question is, what is actually the key difference between the simple moving average, the exponential moving average, and the triangular moving averages? All right, so moving average is a very commonly used technical indicator, okay, usually to indicate trend. But however, right, there are three different sort of moving averages, and what should you really be using? All right, so we're going to be looking at the technical differences, then after we're going to going into the charts to take a look at it. So we have the simple moving average, okay, which is simply the average price over a certain specific period. So maybe if you are talking about a simple moving average of SMA 10, so that means the average price of the 10 candles is at that particular price. Okay, so it's actually a very simple one. All right, then we move on to the next one, which is called the exponential moving average. So the exponential moving average, what we call EMA, is a type of moving average that plays, like I said, greater weight greater weight, right? Okay, and significance on the most recent data points over here. All right, so in this particular case itself, right? Okay, so you can see that the EMA is actually has a greater significance. Okay, so we can look at the next one, which is the triangular moving average. The triangular moving average is basically the double smooth moving average, which means extra weight to the line and is more suitable for the slower moving markets because of the significant lags. All right, so that's something that you want to be looking at. So if you were to place them on the chart, you'll be able to see something like this. Right, so you can see that the simple moving average itself, okay, on certain points is actually doesn't hold that well. So for example, let's look at this particular point here. Okay, let's look at this point. Okay, so if you can notice that this point, the candle, this is actually the S&P 500. Okay, so basically this line actually, it breaks the moving average. This is actually a simple moving average. However, if you look at the exponential moving average over here, do you see that it actually holds very nicely over here? It holds very nicely over here for it to, and then it touches it and bounce up. So that means, right, there's actually quite a number of people using this moving average. And you look at the same point over here, also exhibited the same way. All right, so you can see on a few other points as well, right? For example, you see here, it actually holds very nicely, but however, on the EMA, these two quite a little bit far away. So if you're looking at a potential long entry, you might not want to take the entry, but however, triangular and the TMA, okay, is exhibiting a bounce. So the question is, right, which one should you really take a look at? So we can actually take a look at the by placing them into a single chart, and then we'll be able to find out. All right, so let's take a look. Okay, so over here, we have the white line, which is the exponential moving average. We have the pink line, which is the simple moving average, and we have the turquoise line, which is the triangular moving average. Okay, so on a S&P 500, okay, you can see that there are certain lines that doesn't hold that well. Okay, so for example, let's look at certain points that there is a the 200 moving average, right, actually provided a certain level of significant support or resistance in this case. Okay, so if you can take a look at this, which is the here. So you can notice that at this level, let me just change to a pen. Okay, you can see that at this level itself, all right, the SMA actually provided some minor support, but however not exactly that significant. But however, this level, which is actually provided by the TMA and the EMA, actually had a more stronger bounce effect that the market can actually move up higher. So we can take a look at a few other more points. Okay, let me just how to change it. Okay, you look at some points over here. Okay, so if you can notice that, okay, over here, do you notice that at this level, okay, the SMA doesn't even react. It's like way past the SMA, all right, and then it stops nicely at where the TMA and EMA is located at. Okay, like we mentioned earlier, the TMA, the triangular moving average, tends to work for slower moving securities such as S&P 500, because S&P 500 doesn't have much movement, so to speak, compared to Nasdaq 100 or even in an intraday basis. Okay, so we can see that, okay, there are a few other points that can help you to substantiate the points. Okay, however, you can take a look at certain points. Okay, the gaps here, somehow you actually took the SMA into considerations. Okay, while certain points over here, okay, the what's it called, the TMA, let me see, so this is the TMA and this is the SMA, and over here is the exponential. White color is the exponential. So it doesn't work very well, okay, for the EMA on the S&P 500. So you can notice that the TMA and SMA actually works pretty well, okay, on the S&P 500 over here. So you can take a look at all this, okay, to be able to observe what is actually better for you. So because you must understand that these moving averages is only as useful as the people using it. So what I mean to say that? So that means more people, users, okay, equals to more reliability. Yeah, so the key thing is you need to have more people to use this indicator. But however, basically the market itself is a zero-sum game. You want to be able to tell what kind of studies does your opponent in the market uses. So like for example, if let's say everybody else in the market uses the exponential moving average on your particular security, and then you jolly well switch to the exponential moving average because you wouldn't want to go against them. Or you can actually change a period to make it shorter and make it more sensitive and more reactive, so that you can have a head start compared to the other players in the market. So I think these are certain points whereby you want to be understanding. So the key thing is it's important for you to understand what your opponents are using and use it accordingly, because certain securities, be it FX, commodities, or even equities, or even indices, they react differently to the indicators because different groups of different sets of people are using it. There could be prop traders, there could be the algorithmic traders, they could be the retail traders, it could be fund managers, it could be the high frequency traders. It depends. So most importantly, do your research. Don't just take some other people's strategy and just try to put it onto the kind of security you're trading. So that would be very risky to take. All right, so guys, if you have any questions, do feel free to leave a comment below, or you can actually leave a message for me to take a look at what kind of topics do you want me to cover. All right, so nonetheless, right, I do subscribe to our channel, and most importantly, stay tuned for the next video. All right, thanks guys for your attention, and then we'll see you the next video. Bye.